All right, let's go on with the class. All right, let's proceed with the class. Economic value added as a measure of divisional performance. A quick recap of our discussion regarding economic value added. Economic value added is very similar to residual income. If you recall, your residual income can be used to measure divisional performance. Your residual income is the difference between the profits, your operating profits, or your profit after tax minus imputed interest charges, where your imputed interest charges is calculated as capital employed multiplied by the cost of capital. Now, economic value added is the difference between the net operating profit after tax minus bracket capital employed multiplied by the cost of capital. The basis of economic value added is to exclude accounting assumptions and look at economic profits. Let me explain that again. The concept of economic value added is to look at economic value or by the division. Accounting profits are prepared based on accounting convention and assumptions. Accounting profits are prepared based on accounting conventions. What are these conventions? One is accounting depreciation. If you look at accounting depreciation, it's a convention in accounts to account for depreciation. Depreciation does not involve cash flow. We make provision for depreciation as against replacement of assets when the asset is fully depreciated. But no cash flow is involved. Also, when you prepare accounting profits, at times we make provision for doubtful debt. This provision is in line with accounting principle, accounting assumption. But in real economic terms, no cash is involved. Hence, all the accounting assumptions under economic value added will be disregarded. In other words, you are going to adjust the accounting profits. You are going to adjust your accounting profit after tax so as to derive economic profit after tax. Your economic profit after tax is represented by net operating profit after tax. These adjustments are numerous. However, you are going to be guided by the concept of ever. What items to be added? What are the items to be added to accounting profit after tax? What are the items to be deducted? We explain this. One is accounting depreciation should be added. Provisions. Provision for bad debt, doubtful debt, provision for deferred taxation. All provisions should be added back. Non-cash expenses should be added back. Interest paid, net of tax, should be added back. If there's goodwill, where goodwill can be valued, that goodwill will be added back. Developmental cost, where a company has engaged in research and development, that cost should not be treated as an expense. That cost should be capitalized. There are two types of expenses: revenue expense and capital expense. Any expenses incurred and the benefit is enjoyed within a year, such are regarded as revenue expense. Such expense must be deducted the same year that expense is incurred. A good example of revenue expense is your salary. Salary is the service of the employee is enjoyed the same month the employee is paid. If you now have capital expense are expenses incurred, but the benefit can be enjoyed for several years. Such expense cannot be deducted in one accounting year. Such expense will be capitalized and spread. A good example is your development cost, training and development cost. If you develop a product and you have incurred expenses, inasmuch as that product is giving revenue for many years, the development cost will also be spread over the number of years the revenue will be enjoyed. It will be wrong to deduct that development cost in 1 year. That's why we are adding back development cost. Now, let me quickly say that if you have operating leaks, you need to watch it. In some question, you might need to add back your operating list to the profit after tax. If that operating list expense has been deducted in getting your profit after tax, that operating list expense should not be deducted. The operating list expense should be capitalized over the number of years that service is enjoyed. This aspect, students you cannot memorize everything to be added or to be deducted. But you can have a basis. What is the basis for adding? What is the basis for deducting? Where we can determine economic depreciation. In most cases, examiner will provide this for you. You deduct your economic depreciation. If there's any impairment in the value of goodwill, you also deduct it. You now get your economic profit represented by notepads. Then you have your capital employed. Your capital employed, you are going to start with opening capital balance. You now do your adjustments. Items for adjustments. If you have operating leases, your operating lease should be capitalized. If you have non-cash expense, then your non-cash expense will increase the capital value, your capital value. Lastly, your cost of capital employed. The cost of capital employed. Examiner may give you the cost of capital, or you may be required to calculate the cost of capital. If you are giving cost of capital, you are fine. But when you are not giving the cost of capital, examiner must provide data that can be used for the cost of capital computation. Please watch out. Your work is computed as cost of equity multiplied by the percentage of equity plus cost of debt after tax multiplied by the percentage of your debt in the capital structure. Once you have these three variables, you can now compute your work. Thereafter, we solved just one question. We're looking at the second question when, for network reason or for some reason, technical glitch, we couldn't complete that question. Tonight, we are going to take the second question. We are going to read it first, then we now move to the solution board. Any question, please, before I move to this? To the question on Uzo Chuks. Yes, Uzo Chuks Nigerian Limited is a company established 4 years ago to produce medical equipment. The income statements and statement of financial position for 2019-2020. You have the income statements. You have your profit after tax. You have your finance charges. You have your statement of financial position for 2019-2020. Additional information. Information 1. Operating costs include the following. Depreciation. That means depreciation has been deducted in both 2019 and 2018. This should be added back. Provision for doubtful debts. Okay. Look at research and development. Research and development cost was incurred in 2019, deducted in 2019 profit, but was not incurred in 2020, not deducted in 2020. Look at non-cash items. Note number 2. Economic depreciation is assessed to be 50.5 million. Economic depreciation include an appropriate amortization adjustment in previous year. Include an appropriate amortization adjustment. Full stop. In previous years, it can be assumed that economic depreciation and accounting depreciation were the same. But in 2020, accounting depreciation is different from economic depreciation. Please note that. Tax is the cash paid in the current year, 60 million. An adjustment of 2 million for deferred taxation provisions. Provisions must be added back. There was no deferred tax balance prior to 2020. That means the first provision for deferred taxation was made in 2020. Note number 3. The provision for doubtful debt was 2.5 million in the 2020 statement of financial position. Please note, look at provision for doubtful debt in the income statement for 2020. 1.2 million. But the provision provided in the balance sheet for 2020 is 2.5 million. That means something has happened. Let's go on. Note number 4. Research and development cost is not capitalized in the accounts. That means the company has treated that research and development cost as a revenue expense, which is wrong. You know how I explain it. You have revenue expense. Expenses deducted in full in the year it was incurred. That becomes revenue expense. Capital expense. Expenses spread over a number of years. The benefit was enjoyed. That research and development cost should have been treated as a capital expense. Look at it. It relates to a new project that will be developed over 5 years. And is expected to be of long-term benefits to the company. 2020 is the first year of this project. It means that 5 million incurred. We are supposed to spread it for 5 years, starting from 2020. But it was deducted in full in 2019. Note number 5. The company had a non-capitalized lease assets of 18 million in 2020. These assets are not subjected to depreciation. Note number 6. Cost of capital of Uzochukwu. Equity 18. Debt pre-tax 6%. Capital structure, equity percentage 60%. Debt 40. Then the last note. That last note is another question entirely, sir. Opportunity to invest in a solar projects that will require the procurement of equipment, of an equipment worth 3 million in January 2020 and run for a period of 5 years with a salvage value of 0.5 million, generating a stable net cash flow of 0.85 million. The applicable cost of capital is the associated work of the company. Requirement A, we solved this. Requirement A1, we solved it the last class. Compute and evaluate the company's performance using average rate of return. At our last class, we solved this. So if you have to manage time, we might not need to look at this again. At our last class, we solved this. Then second, compute and evaluate the company's performance using economic value added IMAX. Now, please, assume we have our hard copy. I've only shared this so that we can read together. We are moving to the board for solution. We are moving to the board for what? So this should go. This should go completely, not to distract us. Yeah. Are we good to go, please?
Yes, sir.
All right. Formula for economic value added. Yes?
No parts minus.
Now, please, examiner says just one. Let me share the question one more. No, we have 2 years. Minus, let's open a bracket. Capital employed multiplied by cost of capital. That is multiplied by your work. Now, you know we have 2 years. Allow me to quickly refer to that. You know we have 2 years. The question says, oh yes, you have the question. Please look at the question. The question says calculate economic value added. For which year? Is it for 2019 or 2020? Please, if you are given 2 years and you are required to calculate economic value added, the examiner didn't say 2019. He didn't say 2020. Please calculate for the most recent year. Is that clear, please? Are we there, please?
Yes, sir, it's clear, sir.
Please calculate for the most recent year. Now let's go back to our board. I will have my calculation. I need to get my notepad. Is that not? This is so your 2 naira sign. Your 2 naira sign. Now, please check for 2020 profit after tax. What's the figure? Please check 2020 profit after tax. What's the figure?
48.
48
million.
Good. Now, good. Add back.
Add back.
Depreciation for 2020. How much, please?
28.
20.
Pick your depreciation. Add back item. 28 million. Now check. Bring my question closer to me. Also look at 2020. We have interest net of tax. Look at the finance costs.
Acha. 14,000. 14 million.
But net of tax, look at it.
40 million.
You come here. Our interest net of tax. Now this is how to calculate it. Pick your 14 million, multiply by 1 minus the tax rate. What is the tax rate in this question, please?
25%.
25%, that's great. That becomes 0.5, right? 0.25. Please, let's work this out.
10.5.
10.5, thank you. 10.5. Non-cash expense, any?
Yes.
For 20.
3.0.
2020. Non-cash items, how much?
3.0.
3.0. Good. Good. We have provision for deferred taxation. Look at note number 3. Can we all see it? Examiner say an adjustment of 2 million for deferred taxation provision. Is that not, please? Can we see it, please?
So,
Please look at
what?
note number 3.
Okay.
Look at note number 3. Let's read that note. Tax is the cash paid in the current year. In bracket 16 million. The tax paid is not a problem. An adjustment of 2 million naira for deferred taxation provision. Can we see it, please?
Yes, sir.
We are going to add back. Provision for deferred tax 2 million. Next, go to our accounts. Look at provision for doubtful debt. How much affected our P&L?
1.2.
Thank you. Add back. That 1.2, look at it. Look at that note number 1. Examiner says operating profits include the following. Please focus on 2020. Depreciation 28 million. That means we have deducted depreciation. That means depreciation of 28 million has been deducted in the profit of 2018. This must be added back. Next, provision for doubtful debt of 1.2 million has been included in the operating profit. That means 1.2 million provision has been deducted from the operating profit from the profit of 2020. This provision is an accounting assumption. This must be added back. Is that clear, please? I will now come here. I'll come here. Provision for doubtful debt. $1.2 million. Now, you observe, please just be careful with it. You can always get your full mark here. Our development cost was deducted in 2019, not 2020. Our development cost was deducted from the profit 19. It wasn't deducted from the profit of 2020. So you cannot come and add back that items, because that items has not even been deducted from 2020 profits. But if the examiner has placed that 5 million development cost under 2020 operating cost. That means that 5 million has been deducted from 2020 profit. In that case, you are going to add it back to 2020 profit. What I noticed with this topic is to some extent, is testing your knowledge of accounting principles. So these are the items to be added back. You now come to item to be deducted. Please sum this item, 28 million plus 10.5 plus 3 plus 2 million plus 1.2. What do you have, please?
$44.7.
44.7. You now come to items to be deducted. Do we have economic depreciation in 2020?
Yes.
Look at note number 2. Look at note number 2, please. Economic depreciation. How much, please?
50.5 million.
This will be deducted, 50.5. Then look at note number 4. Research and development cost. Research and development. No, note number 5, sorry. Note number 5. Research and development is not capitalized in the accounts. It relates to a new project that will be developed over 5 years. And it's expected to be of long-term benefits to the company. 2020 is the first year of this project. Now, that development cost is 5 million. We are going to amortize that cost for 5 years. We are going to years. So come here. That cost was incurred in 2019. It was deducted in 2019. However, the cost will be spread. However, the cost will be spread. For 5 years. So you are going to come here. Hey, this mouse. Amortization. Amortization of development costs. Of development cost. Please, if you divide by 5, that will give us 1 million yearly, right? 5 million divided by 5. That becomes 1 million yearly. You are going to recognize 1 million in 2020. Then, if you have 2021, 2022, but we are only doing for 2020, assuming you have prepared economic value added for 2019, we'll have added back that 5 million development cost. We now amortize for 5 years. The benefit will be enjoyed from 2020. then you are going to spread the cost for that 5 years. This is closer to what we call matching concept. Matching revenue, relevant revenue with relevant cost. The benefit will be enjoyed from 2020 for 5 years. Then the cost will also be spread from 2020 for 5 years. So these two items will be deducted. Is that clear, please? Is that point clear, please?
Yes, sir.
1.5 here. So you can now get your notepad. Your notepad. Please add 48 million, 44 points.
Excuse me, sir.
Less 51.
The first calculation is not correct, sir.
Oh, which one is not correct, sir?
44.7 is not correct. It's 45.2.
Oh, are you sure?
Yes, sir.
28 plus 10.5 plus 3 plus 5 plus 2 plus 1.2. Can we confirm that?
It's 44.7. Correct.
All right. Please, final answer.
44.7.
44 point. No, final answer.
41.2.
41 point. You have gotten your notepad. 41.2 million. Any question to this, please? Yeah, it is correct. Thank you, Victor.
Sir, please, I have a question on the provision for doubtful debt.
Okay.
So, in the question, I'm seeing that for 2020 is 1.2, while in the additional information, we have been told that doubtful debt for 2020 is 2.5. Does it mean that?
Please complete it. Doubtful debt for complete that. Read it completely.
Provision for doubtful debt was 2.5 million on the 2020 statement of financial position.
Thank you. Where was it staying? Is it the income statement?
No.
Thank you.
So I'm
Examiners,
trying to ask you that. Does it mean that doubtful debt was initially 2.5 minus 1.2? Was initially 1.3.
debt
Then it
was
increased to 2.5.
Thank you. Doubtful debt was increased in the balance sheet.
Oh.
If you now want to make, in your balance sheet, you are going to go with accumulate. Okay, if you do balance sheet, we go with accumulated depreciation, Abby. Is that not?
Sir. Yes, sir.
But if you are doing income statement, you only take your depreciation for the current year. Is that not?
Yes, sir.
Now look at what happened here. The implication of this note 4 is that there's an existing provision for doubtful debt before. It was now increased by how much now? If you compare 2.5 minus 1.2, by how much was it increased? It was increased by 1.3. Is that correct?
Okay, so that means initially it was 1.2.
Yes. Now, if you now get to adjustment to your if you get to the adjustment to your capital employed, this provision now, we are going to reflect that differences. The only aspect that affected the income statement for the year under review is 1.2 million. If you get to the capital employed now, which we are going to next, you know, we have resolved note parts. We are now moving to capital employed. Our capital employed too. This provision we have impact in it. But it is the differential. Is that clear, please?
Yes, sir. Yes, sir.
By the time we move to capital employed now, okay, that differential we have impact is the differential that will affect my capital employed.
Sir, I have one question, sir. Regards what you
Feel free
just
to ask me.
So my question is, you know now, the provision we have in the statement of financial position now, we have 2.5. The one on the profit or loss account is 1.2. So if we are given a question like this in the exam, how do we know the one that is reducing? Since in the income statement, we added back increment in provisions and with less reduction in provision. How do we know the one we are adding back as increment and the
Now
one
look
we
at
are
it.
subtracting
Okay,
from?
a good question. Examiner, make it clear to us. Please go to note number 1. Are you there, please?
Yes, sir.
Okay, go to the income statement first. Operating cost for 2020, how much? 200 million. Can you see it? Can you see that income statement?
Yes.
200 million. Now look at note number 1. Operating cost in depreciation, how much? For 2020. How much, please?
28 million.
You don't have the question?
I have it, sir. 28 million.
20. That means this 28 million is part of this 200 million. Is that not?
Yes, you are right, sir.
Good. Then look at provision for doubtful debt. How much?
1.2 million.
You see, that examiner is telling you that 1.2 million was the provision for doubtful debt deducted from that profit. It is the amount of provision deducted from that profit that will be added back. He now went to the note number 4. He said provision for doubtful debt was 3.5 million, sorry, 2.5 million on the 2020 statement of financial position. Now, it means that in our statement of financial position, we have added 1.3 to it. One existing before. We now added 1.3 to it. Only 1.3 we now affect your adjustment of capital employed. One good thing about this question that I noticed, examiner always provides guidance. What you are going to add back or what you are going to deduct is what has been given to you in the question. In this question, examiner says only 1.2 million provision for doubtful debt is included in operating cost. If the examiner has said 1.8 provision is included, whatever is included in your operating cost is what is going to be added back to the profit after tax in order to derive your net operating after tax. Now, if there's a difference between what is in the income statement and what is in the statement of financial position, it is the differential that will affect your capital employed adjustment. Is that better, sir?
Yes, sir. Sir, and secondly now, sir, let's assume that in the income statement, we are given like other income before operating cost. So can we say that the other income and in the notes to the account, we are given like a provision that, let's say, a provision of 20 million naira is added and is included in other income account. Can we say that one is reduction in provisions?
Now, let's get it clear so that all of us will benefit. Other incomes. Other incomes. Is that other income already part of profit after tax? Is that clear, sir?
Yes,
Is
sir.
that other income, is it part of profit after tax? If that other income is part, we don't have problem now. But if that other income has not been included in the profit after tax, then we have issue. Are you there, please?
Yes.
If that other income is already included in our profit after tax, that means we don't have issues. It has been accounted for. But if that other income has not been included, we now need to ask ourselves, one thing I love about this topic, for me, and in fairness to institute, they know that there are several adjustments here. They always provide sufficient guidance. Personally, I don't allow students to cram. I want students to have understanding of that principle. Because I don't know how the examiner will navigate the question. Now you have navigated to include other incomes now. I will now go and look at the notes to that other income. Examiner must tell me if this other income is creating economic value or not. No economic value added. We want to see those items that are adding value to the business, and those items that are not adding value to the business. Is that clear? So it's not very easy to quickly frame a question and let's start adjusting it. It's not very easy, whatever. I hope the point is clear, sir.
Yes, I understand, sir.
So that I will not go and give you a response that will force you to a particular place. Once you are attending this question, one thing I've noticed, examiner will give you information. All right, let's look at second working capital employed. Your capital employed. Capital employed. Start with opening balance. Opening balance. We are looking for capital employed for 2020. Don't forget. Capital employed for 2020. Now go and check here. How was the closing capital employed for 2019? That becomes opening for 2020. Please check closing capital employed for 2020. Now let's go to the statement of financial position. Look at 2019. Shareholders' funds. How much, please? For 2019.
400.
Then long-term debt, long-term and medium-term debt, how much?
100.
100 million.
That means the closing capital employed for 2020 is for 2019 is 500 million. When we say capital employed, capital contributed by the shareholder plus funds contributed by the debt holders. My shareholders fund 400 million. Long-term and medium-term debt 100 million. If I add these two together, I'm going to get 500 million. It was closing for 2020. It becomes opening for 2020. But it was closing for 2019. It becomes opening for 2020. I will pick my 500 million. I will now come to adjustments. I will come to adjustments. Any operating list?
I saw the question, sir.
Yeah.
Yeah. For the capital employed.
Please go ahead.
For the capital employed, the one you just did now. I was thinking
Yeah, capital employed. Yes, what happened?
I was thinking the formula for capital employed was total asset minus current liability.
Yeah, you are correct. You are correct. What is total asset in this business?
540.
Less current liability, how much?
40,000. 40 million.
So what's your answer?
500, sir.
Well, you see, the issue with students is we have crammed some formula. Do you understand? I was expecting this question from students. Personally, I don't allow students to, what happens if you are not giving total asset? First, understand the concept of capital employed. Capital is money contributed to the business. Who contributes capital to the business? The shareholders and the debt holders. Personally, I don't like the student cramming things. I always ask myself, what happened? Yeah, they'll tell you capital employed is total asset less current liability. What happened if the examiner excluded total assets? But if you understand that capital employed is the money the shareholders has contributed, plus the money the debt holders has contributed. That is the capital the business has employed. Capital employed. Money we have employed for business operation. You are very correct. If you have calculated total assets, if you look at 2019, 540 million, less current liability, 40 million, you still get to 500 million. But once you understand the concept, you know that whether I take from total assets or I move that into capital employed, I'm sure that I'm correct. Is that clear, sir?
Yes, sir.
So it's good that we also learn it now, because the examiner can be funny. It will deliberately remove total assets, deliberately remove current liability. It will not tell you to go ahead and compute. Now, do we have operating list? Look at note number 6. Operating Oh yeah, how much?
18 million.
18 million. Do we have non-cash items? For 2020, how much?
$3 million.
Provision for doubtful debt. Doubtful debt will affect your current. Your doubtful debt is coming from trade receivables now. Trade receivables is part of your provision for. Now is the differential. Please, I need to take this off, please. Let me take yes. Increase in provision for doubtful debt. That question you ask now, difference between 2.5 and 1.2. What do you have, please?
1.3.
I think that should give us 1.3 million.
Yes.
It is that differential that we now impart on your is that differential that will now impart on your stuff there. That differential. This is the capital employed now. This is what we call economic. This is what we call economic capital employed. Please sum up. What do you have, please? 500 plus 18 plus 3 plus 1 point. 22.3. And your working 3. Let me check what is trying to chart. Your working 3.
Sorry, for the working 3, sir.
Oh, they are unable to join. Oh, sorry, I don't know. But nobody is on the. Anybody waiting? Nobody in this thing now. Nobody in the waiting room. I can't see anybody in the waiting room here. I cannot see anybody in the waiting room. I've checked. Nobody is in the waiting room. Don't know. Yes, somebody was trying to ask a question.
Yes, sir, I was the one.
Yeah.
Yes, sir. The no cash item you used here, you used 3 million. So I just want to ask why we're not using the 4 instead of that we now use the 3, because 4 was for 2019
Just,
and
it's a simple thing. 4 is for 2019. And we are preparing capital employed for 2020. 3 million was deducted, 3 million was the non-cash items. These non-cash items, that means no cash, that means our cash flow is not reduced. Our cash flow for 2020 is not affected. And your cash flow is part of your current asset. Your current asset is part of capital employed. So that 4 million is for 2019. Is that clear, sir?
Yes, sir.
So the last aspect of our working, is to calculate your work. Please allow me to attend to the students. I don't know what's affecting them. Just 1 minute. Because maybe it's supposed to be the chief host. I don't know. All right, let's continue. I'll just try to respond to the students. I don't know why they're having that problem. Now your work, to compute your work, just simply come here. Please check what is the cost of equity. Please check. Look at note number 7. What's the cost of equity?
$16.
18%. Our cost of equity is 18%. Okay. Okay, let me not use symbol. When you get to final, we're going to use equity 18%. Cost of debt, how much, please? Examiner say pre-tax cost of debt. Cost, how much, please?
6%.
6%. Then you need to calculate after-tax cost of debt. Is that clear, please? Look at after-tax. After-tax cost of debt. This is equal to 6. This is equal to 6 multiplied by, open a bracket, 1 minus, what is the tax rate? 25%. Please compute. Get your after-tax cost of debt.
Okay, it's fine.
What do you have?
4.5.
4.5. Please, when computing your work, you must use after-tax cost of debt. Except the examiner says there is no tax. Is that clear, please? 4.5%. Okay, we can save this, move to the next. Let me save this, move to the next page. After the...
Sir, please,
Yes,
I have a question.
please go
Sorry,
ahead.
I joined in late. For when you are calculating NOPAT, the 14 that you use as
Has been what? Please complete your question. The 14 that you have been what?
you use in calculating the tax 14
Uh,
times 1 minus 25%.
uh, we have deducted tax here, so we should not take it again. Yes, I'm listening.
Yeah, I'm just asking the 14 you use to multiply 1 minus 0.25.
That was the question. I want to get that question clear.
But he's asking of the finance cost. Is the finance cost? That's 14.
Yes, I think he didn't know where they picked the figure
Yes, they
from.
got it. The finance cost, the finance charge in the income statement.
Okay, is that your question? Are they speaking your mind? Hello?
Okay. Yes, I'm with you. Okay.
Please, are they speaking your mind or you have another thing?
No, I think, but what you wrote is interest net of tax. That's what I'm seeing here. But though now, since they said it's a finance charge, okay, from the finance charge, I can see 14 for the year 2020.
Okay,
so I think I'm good.
okay. Yes, the interest, your interest is also your finance cost.
Okay.
Is that okay? The interest you paid on your debt is also the finance cost or finance charges. Okay. Is that clear, sir?
Yes. Thank you very much.
Okay.
Yeah.
I was thinking you want to say we should not deduct tax here. Please note, at any point in time you are computing your work, your cost of debt must be after tax. At any point in time. Unless the examiner says there is no after tax. For this level, pass and come and meet us in final. You are not going to see work as a whole. Why is it that tax must be deducted? Then you are going to get, but at this level, examiner will not worry you. Just compute your work. We have gotten the figure, we have saved this. Let's move to the next page. Please notice cost of equity 18%, after tax cost of debt 4.5. I can come here. Second page, we continue here on the second page. Now, what is the percentage of equity, please? Percentage of equity. What do you have, please?
18%.
No, that is cost of equity.
Oh, okay. 60%.
60%. What is the percentage of debt?
40%.
40%. Please also note, examiner can play trick. If examiner give you, note, two of them must give you 100%. Examiner can give you cost of percentage of equity. It now remains silent on the percentage of debt. The addition of percentage of equity plus percentage of debt must always give you 100%. Examiner can also play trick on you. It will now say the percentage of equity is 60%. It will now remain silent on the percentage of debt. You should be able to interpret fast that if equity is 60%, since everything, percentage of equity, percentage of equity plus percentage of debt must give me 100%. So if the examiner has said equity is 60%, please quickly interpret that. That means debt is what? 40%. Is that clear, sir? So you can come here now.
Yes, sir.
Formula for work. Our work is equal to, open a bracket, cost of equity multiplied by percentage of equity, close your bracket, plus open another bracket, after tax cost of debt multiplied by percentage of debt. I can now come here. Our work is equal to cost of equity 18%, percentage of equity 60%. You can take 0.6 or you can even put 60%, it doesn't matter. Plus after tax cost of debt 4.5%, multiplied by percentage of debt 0.4, 40%. Please work this out and give us the work. Please allow me to take water. Please do your working and stop. Yes, final answer. Yes, final answer.
The final answer is 0.1.
10%. Is that the final answer?
Yeah,
0.
that's what I got.
Is that the final answer?
0.126.
Okay. Final answer?
0.126.
0.126. You can take it to percentage.
12.6.
Thank you. 12.6%. We can now calculate our EVA now. Your EVA, remember the formula, notepad minus bracket capital employed multiplied by weighted average cost of capital. Pick your figure. Economic value added is equal to, what do you get there? 41.2 million, Abby? Is that not? Okay, let's go back to it.
Yes.
Let's check. 41.2. Then our capital employed 5. No, I will do it. I'll come here minus, open a bracket, capital employed 522 point what? 0.3 or 2. Yes, 0.3 multiplied by WACC 0.126. Close your brackets. What is your ever? Please work this out. What is your ever final answer?
Minus what? Minus 24.6.
Negative 24.6. Minus 24.6 million. That's serious. That means this division, Abi, or this company is not creating value. Your comments. When you are done, let's comment on this. Our comments. Of course, we need to comment. You are going to comment on this. Your material shared the solution. And let's pick the comments. The business is not creating value for the owners. This company or this business is not creating value for the owners. It's destroying value. Is that clear, please?
No, sir. Please just repeat again.
The business is not creating value for the owners. That's all. Once you have a negative sign, that business is not doing well. Now we are done with that. The B part, sorry, the C part is investment appraiser. I'm not sure Juan has taken you guys investment appraiser. But we can do it. Juan will still take you full investment appraiser. We can solve the C part also, it's not a problem. Now, let's look at that requirement. That last note, the last note number 9. For my question, you have note number 9. Let's take the reading again. The company has the opportunity to invest in a solar project that will require the procurement of an equipment worth 3 million in 2020. That 3 million is the initial capital outlay. That is the initial investment cost. That will be in year 0. That means 2020 is year 0. And run for a period of 5 years with a salvage value of 0.5 million. That salvage value is your scrap value. That will be in year 5. Generating a stable net income of 8.5 million. That's for 5 years now. Generating a stable net income of 8.5. The applicable cost of capital is the associated weighted average cost of capital of the company. You have computed the WACC, 12.6. So that now says we should calculate. Look at requirement C. Calculate the net present value of the solar projects for the life of the investment, 7 marks. It was a dash. I'm wondering this that dies. Let's save this also. I think I'll save it. Let's deal with this. How do we compute net present value? Yes, even though you have not done the topic. How do we compute NPV? Your NPV is present value of inflows minus present value of inflows minus present value of outflows. You can come here now. Just open your table. The year, item, your cash flow, your discount factor, then your present value. At least, if I'm not mistaken, you must have done this at one point in our career. You come here, year 0, year 1, year 2, year 3, year 4, year 5. I'm going to have 2 year 5. I can explain that. In year 0, initial cost of the project. What is the initial cost of the equipment, please? Initial investment cost or capital cost?
3 million.
3 million. 3 million naira. If I want to put it in full, year 1 to 5, the project will generate cash inflows. Cash inflow. Cash inflow. Examiner says 0.85 million. Can we all see it? Hello? Can we see it?
Yes, sir.
That's the inflow from year 1 to year 5. I'm just writing this to explain. Inflow, year 1 to year 5. Cash inflow, 0.85 million is the same as this and outflow. This will be in brackets. 850,000 850,000, 850,000, 850,000. It's an inflow. 850,000. Also in year 5, there's a salvage value. You can dispose that equipment, that is the salvage value. It's also called the scrap value, salvage value. You can dispose the equipment to get 0.5 million. That's 500,000. Your work is 12.6. Now we need a discount factor. What discount factor formula? What is the formula for discount factor now?
1 plus R raised to power.
I thought you say you don't know. Discounting factor formula. Discounting formula. 1 plus R into brackets raised to power minus N. Oh yeah. In year 0, what is the discount factor?
1.
1. Thank you. Year 1, please compute. Year 1, year 2, year 3, year 4, year 5. Using this formula. Using 12.6 as your R is 12.6. So for year 1, you are going to have 1 plus, what do you have?
0.888.
0.881.
No, it's there.
Year 2, how much? Somebody can do year 5 now. We can make it faster.
0.789.
789. Year 3, what do you have?
0.700.
700. Please, and I'm assuming that we all know how to compute this. Next.
0.622.
5.
0.622.
0.622. Year 5, what do you have?
0.55.
552.
0.552. You can now multiply the cash flow by the corresponding 3 million multiplied by 1.
Minus 3 million.
That will give us 3 million negative. Next.
754,800.
754.
800.
800. Next.
670, 650.
670.
650.
650. Next.
595. 595,000.
595,000. Next.
528, 700.
528. 700. Next.
469, 200.
469, 200. Next,
276.
2,
270,000.
6, 0, 0, 0. Get your MPV. Please sum up. Negative, you can add your positive first, then deduct it from your negative. Present value of inflows minus present value of outflow. What is the MPV? This was 7 marks. I'm sure I can or just dashing mark out that. 7 marks, London or Philip.
297,350. Positive.
297.
350.
350.
350.
Once your MPV is positive, it means the project is financially viable. Project is financially viable and should be undertaken. You are done with that question fully. You are done with that question fully.
Continue.
Okay. Any question, please? Let's look at illustration 3. I don't know if the time will allow us, but...
No, sorry. Please, can you come explain to me how we got that discount factor of 12.6?
7 point what? How we got what, please? 12.6. Hello?
Yes, sir. Yes, sir.
Oh. Is here now? Surprise. Where's my working self? Okay, I've saved it. Let me look at it. See, new bodies give me. Okay, it's here now. And it's there. It's our cost of capital now. Look at it now. 12.6 now. Can you see, sir? Hello?
Okay, yes, sir. Yes, sir. Thank you.
Your discounting factor for a project is your cost of capital. The company will use your cost of capital. When we say cost of capital, is the minimum amount a company must generate in order to meet the expectation of the providers of capital. The cost of capital, that is the minimum amount of returns a project must generate in order to meet the expectation of the providers of capitals, and is used as a discounting factor. All right. Let's look at illustration 3. I'm not sure the time we might be able to finish, but let's see how do we navigate. Epoch Power Nigeria Limited, in bracket, IPN, is a power utility company providing power distribution services to public, South Nigeria. The company was formed when the government-owned Power Holding Company of Nigeria was broken into regional utility companies, one of which was IPN, and sold into private ownership over the 4 years period. As a vital utility for the economy of Nigeria, power services are a government-regulated industry. The regulator is principally concerned that IPN does not abuse its monopoly position in the regional markets to unjustifiably increase prices. Majority of the services, in bracket 80%, are controlled by the regulators, who set an acceptable return on capital employed and ensure that the pricing of IPN within this area does not breach the level. Remaining services, such as provision of meters and contract repair service, are unregulated, and IPN can charge a market rate for this. The regulator calculates its ROEs figure based on its own valuation of the capital assets being used in the regulated service and the operating profits for those regulated services. The target pre-tax return on capital employed set by the regulator is 6%. If IPN were to breach this figure, then the regulator could fine the company. In the past, other such company has paid fines amounting to millions of naira. The board of IPM is trying to drive the performance for the benefit of the shareholders. There is a new experience for many. This is a new experience for many at IPN who left the public service 4 years ago. In order to try to better communicate the objective of maximizing shareholders' wealth, the board has to introduce economic value added as the key performance indicator. The finance director has provided financial information for the year ending 30th September 2018. Revenue from regulated business, revenue from non-regulated business, operating costs for both, operating profits, finance charge. Your finance charge is also your interest expense. The finance charge is for the company as a whole. The company decides to borrow money. You are paying interest. The interest is not regulated by government. So it has nothing to do with that regulation or no regulation. Profit after tax is
2019, or at the late part of 2018, it was a time for Access Bank to acquire Diamond Bank. Everybody was thrown into turmoil.
After pause, let's see who is completing the class.
Of uncertainty of what next.
Somebody. All right, thank you for muting. Let's continue, please. Now, the first schedule is your income. Now, look at the capital employed. Capital employed measured from published accounts. Measured from by the regulator for regulated service only. This already here. It's already here now. regulated. So regulators say your capital employed is this. But in the company published accounts, this is it. Now look at it now. Examiner didn't give us total asset. Now notes to the accounts. I have 2017, 2018. But the income statement I have here is for when? It's just for 2018. Okay, let's go to it. Total operating costs include depreciation. Look at it. That means this operating cost we have here, this operating cost I have here, include depreciation of 29.5 million, provision of 1 million, research and development costs was included in 2018. Non-cash, 3.5, 2018. Note number 2. Economic depreciation is assessed to be 4.5 billion in 2018. Economic depreciation include any appropriate amortization adjustments for previous years. It can be assumed that economic depreciation in previous years, it can be assumed that economic depreciation and accounting are the same. Very similar to the last question we solved. And both were account questions. Note number 3, tax is paid in cash. An adjustment of 0.25 billion, deferred taxation. There was no provision balance prior to 2018. Provision for doubtful debt. Provision for doubtful debt was 2.25 billion on the 2018 statement of financial position. Look at the amount affecting income statement, 1 million. Look at the statement of financial position, 2.25. Note number 4. Research and development cost is not capitalized in the accounts. It relates to a new project that will be developed over 5 years. And it's expected to be of long-term benefits. Please, do I need to solve this for you? Hello?
Yeah, with you, sir.
I'm asking a question. Do I need to solve this for the guys in the class?
Yes, sir.
I don't think
please.
so.
We can try it as assignment, sir.
No, I don't want to be, because I'm looking at it. Okay, let's solve it in this class. Pick your, please deliberately discipline yourself. Pick your, what's it called? Solve, and let's solve it in next 10 minutes. Let me see. Compute NOPAT for compute ever for 2018. Yes, let me see. Compute EVA for 2018. 10 minutes.
So are we going to use the regulated or non-regulated
Okay, but the examiner says use that you are going to do for the company. In this case now, if you are picking figure, it didn't say regulated. You only have one profit after tax now. Is that not? You don't have profit after tax for regulated. So you are going to pick for the company as a whole. Examiner didn't say calculate EVA for regulated or non-regulated. Examiner say compute EVA for me. The EVA you are going to compute is the EVA of the company. Please, let's drive this for 10 minutes. In fact, 10 minutes is much. I'm waiting. Four minutes remaining. Let me share my whiteboard. 3 minutes. Oh, God have mercy. One minute. One minute. Please submit. Now let's now mark ourselves down. My error. Please remember, I'm going to calculate for 2018. Notepad minus brackets capital employed multiplied by my work. Close. Immediately I take my notepad out. 2 naira sign is given in billion. I will start with my profit after tax. 2018, my profit after tax giving 17.75. 17.75. Add depreciation. For 2018 depreciation, go and check your notes. Note number 1.
29.5.
29.5. 29.5. Next, I have provision for doubtful debt for 2018 provision for Why is taking this thing along? Stop. Come on, pick my pen, Joe. The household debt. Debt. I have 1 million included. Then research and development cost, R&D. I need to add it back. It shouldn't be deducted, it should be capitalized. Then my non-cash item, I need to take it back. I'm on 3.5. Then I will check in the accounts, interest net of tax, interest net of tax. Your interest is your finance charge. Go to 2018. Finance charge 11.5 million net of tax. I'll come here.
Sorry, sir.
Yes, I'm
Sorry, sir.
listening.
For the R&D, the note said it is not capitalized in the account.
Yes. So we need to capitalize it now. Is that not?
Okay.
When we say non-capitalized, that means we have treated this as an expense. We didn't capitalize it. Capitalize means we are supposed to spread over the number of years that benefit will be enjoyed. Is that clear, please? When we say non-capitalized, that means in 2018, the 6 million was included as part of operating cost. That means that has reduced our profits. We have treated as a revenue expense. And that should have been treated. Revenue expense, expenses deducted in full in the year it was incurred. Capital expense, expenses spread for number of years the benefit is enjoyed. We have not capitalized it. We are not going to capitalize it. Capitalizing means you are going to divide by number of years the benefit will be enjoyed. You now spread it.
Okay, sir. But in the previous question, we didn't add it to.
Go and look at the previous question. Did it happen in 2020?
Oh,
go back to that previous question. When did it happen? Quickly go back to it. It happened in 2019. And we are preparing ever for 2020. Can you see it?
Yes, we get to know, sir. I get to know, sir.
Is it? I hope it's better.
Yes, sir.
No, I'm fine. You're asking that question. Look at the examiner says operating cost included. That means the following has been included. In 2019, it was included. But you are preparing ever for 2020. That cost was not included in 2020. It was included in 2019. That was the previous question. But this question, the research and development cost was part of 2018. It has been deducted. You need to add it back. Is that clear, please?
Yes, sir. Very good.
No, it's good. It's good you're asking. I'll come here, multiply by 1 minus my tax. What is the tax rate here?
25%.
25%. $0.25. Please work this out. What do you have, please?
8.625.
8.625.
625.
8 0.625. Then we'll go back to it. What other thing? Look at note number 3. Tax is tax paid in the current year, 4.5 billion. An adjustment of 0.25 billion for the taxation provision. There was no provision as balance prior to 2018. That means 2018 was the first year. Back. Come here. Defer tax provision. Zero 0.25. Then you move to item to be deducted. You can sum up this less economic depreciation.
Everything is 48.875.
48.875.
75.
I will come here. Economic depreciation, how much? How much, please?
5.
41.5 to be deducted. $41.5. Now you now have amortization of development costs. Now that note you are referring to now. Look at note number 5. Research and development costs is not capitalized in the account. It relates to a new project. That will be developed over 5 years, Abi. Is it 5 years? Is it 5 years?
Yes.
Okay. Over 5 years, and is expected to be of long-term benefits to the company. 2018 is the first year of this project. That 6 million, you are going to divide it by 5. That's what we call capitalization now. You are not going to spread it yearly. Instead of deducting 6 million at once, you are going to amortize it. Amortization. Where's my pencil? Come here. Also less amortization of development costs. Of developments. There's a point here. Developments costs. I will now come here now. 6 million divided by 5. I need to spread it. Please divide. What do you have?
1.2.
You have your 1.2.
1.2.
Your 1.2 million. Is that 1.2 million we are now going to deduct, not the 6 million? So these two items will be deducted. Please add 41. This will give me 42.7, Abi. Yeah. You can now get your notepads. 17.5 plus
That's
40.
it's supposed to be
What do you say,
profit
please?
after tax is 17. Profit after tax is 17.75.
Are you serious? Oh, 17, no, 17.75.
Yes, sir.
Let me just take eraser. Then my pen back. 17.75. You can add now. The final figure?
23.925.
23.
0.9.
Come here. $23.925. Next, this is working 1. You're working 2. You can do like this. You're working 2. Adjusted capital employed. Please start with opening capital. Please, the capital employed you are going to please is from your published accounts, not the one given by regulator. You are preparing your company ever, not for regulator. So what is the opening capital employed?
318.5.
Look at 2017, how much?
318.5.
That was closing for 2017. It becomes opening for 2018. That becomes, let me just put it here because of space, 318.5. I will now come here. Any operating lease?
No, sir.
No.
We don't have Abi?
No, sir.
Okay. Yeah, that should go. We don't have operating lease. Come here. My eraser. I thought we have. Just bring back my non-cash
item.
My non-cash item. Non-cash. Add it. 3.5, Abi? Yeah. Non-cash is 3.5. 1, 2. Yeah, 3.5. Increase in provision.
2.25.
Increase in provision is for doubtful debt too, because that one will affect your doubtful debt is coming for trade debtors. That will affect your capital employed. Provision for doubtful debt, for doubtful debt. Examiner says, look at note number 4. Provision for doubtful debt was 2.25 billion on the 2018 statement of financial position, minus what you have in the P&L, 1 million. Difference That should give me
1.25.
1.25. Thank you. I will come here. My 1.25. That's all. Please get your capital employed, adjusted capital employed. This is the adjusted. Total.
323.25.
3, 2, 0.25.
323.25.
323, okay. Then you can quickly compute your work. Your work.
So sorry, I want to ask.
Please go ahead.
Why are we not adding the research and development, the amortized percentage in this capital employed?
Why are we not adding what?
The amortized development, research and development cost of 1.2 into this one in the capital employed.
No. The benefits and the cost will move in line. Matching concept.
Okay.
It's an expense. That's
Yeah.
6 million. The only difference is that we don't want to recognize the 6 million at once.
Yes.
Spreading that cost for 5 years. We started from here. It will not impact on your capital employed. It's assumed that the benefit is coming in form of revenue. Are you there, please? You match revenue with the cost. Instead of taking the 6 million at once, you spread it for 5 years. Each year you generate revenue. You now introduce 1.2. Assuming we are doing for 2021 now, we are going to generate revenue. Then we introduce cost of 1.2, amortization of developmental cost. But you are not going to take it to capital employed, please.
Okay, sure. Okay.
And quickly your work. Because of time, it's already time. Your work. Look at the formula. Cost of equity. How many percent? 16%. Look at note number 6. Returns cost of debt. Returns cost of debt.
5%.
Is equal to 5%. Quickly compute after tax cost of debt. You come here.
3.75.
Okay, I will still write this. After tax is equal to 5% multiplied by 1 minus the tax rate, 0.25. That will give me 3.5, Abi. Is that correct?
3.75.
75. Then my percentage of equity, how many? 40. Is that not? Look at note number 6.
Yeah, 40.
40%. Percentage of debt,
Is 60.
60. My work, based on the formula, is equal to cost of equity 16 multiplied by percentage of equity 40%, 0.4. Close the bracket, plus cost of debt after tax 3.75% by 0.6. Your final answer?
8.65%.
Please note that. Move to the next page. 8 point what?
8.65%.
Work 8.65%. Then our ever is equal to notepad. Our notepad figure we got how much? Let's not waste time. 23.925 925 is equal to 23.925 minus capital employed 323.5, Abby?
25.
Multiply by what?
25, not 5.
What's the answer?
The other one is 3.25, not 5. Yeah.
Okay, I'll come here. I have 25 here. 0.0865. Please compute your ever.
.036.
Minus 0. Ever
Final
equals to minus
answer, negative
4.036.
4.036. You are done. Once you have negative sign, that business is not good enough. That company is destroying value. It's not creating value. All right. We are done with that. You can look at the B part and the solution. You just calculate your rules.
I have a question, sir.
What do you say, sir?
Sorry, I have a question. I missed it in the previous solution. The provision for doubtful debt under the capital employed, I don't understand how you got it.
Okay, let's look at it. Doubtful debt. This 1 million. Is that what you are referring to?
1.25 is one she's talking about.
Or 1.25. Okay. Once you get to your capital employed, you are going to compare. Please look at note number. Look at note number 4. Provision for doubtful debt was 2.5 million. No, is that the question? No, that was the question. Note number 4, yes. Provision for doubtful debt was 2.25 billion on the 2018 statement of financial position. Now, what you are going to take is the increase or decrease. In the income statement, we have 1 million. In the statement of financial position, we have 2.25. That means there's an increase. You now compare 2.25 minus 1 million. If you check that out, 2.25 minus 1 million will give you 1.25. Is that that increased portion that will affect your adjustment for capital employed? Is that clear, please?
Yes, sir. Thank you, sir.
Welcome. All right. We need to go. May God give us a better understanding. Our next class. Good night and let's remain blessed.
Thank you, sir. Good night, sir.
We'll share the working after the class that you can have it.